just winding my day down, hearing about mergers and acquisitions in the South. And we're going to hear from JD, who is the CFO of LendingTree, and Marc, who is the CEO of Atlatl, which is here in Charleston. So welcome. I hope you have had a wonderful first day. I have. And without further ado, let's bring them up for a fireside chat. So thank you.
All right. So first of all, thank you.
Thank you.
For coming, being part of Dig South. Welcome. We appreciate it. So getting right into it, I wanted to kind of level set with something that I think everyone recognizes, the OpenTable IPO, and you were part of the deal team on that. And just give us a sense of capital markets at that time.
Sure.
Where were they at, what they feel like, and we can go in from there.
It was funny, it came up this morning on something else. And it's interesting now that my old job when I was at Merrill Lynch and at B of A was in the equity capital markets group. So I was the banker who specialized in taking companies public. And OpenTable was notable largely because it was the first growth IPO post the events of 2008. And to put this in context, as you look at what's going public today, there was one company that went public in the fourth quarter of 2008. It was really a period of just no activity given what was going on in the economy. And so OpenTable was really interesting because it was at least a predictable growth story, but the question was, were there investors who were willing to take on something like that at the time, and particularly something that small? What was the point? It's kind of interesting when you see things like Pinterest going public. OpenTable was, at its initial range, was $33 million that was being raised or available to the public. And then it was ultimately $70 million, and then we did a follow-on transaction in September of that year. What was interesting about OpenTable was just what we called the cohort analysis of how they were able to grow they were going to grow from their core in San Francisco and into other markets. But that was also a company that had been around for about 11 years before going public, which is very different as well.
Yeah, much smaller than we're seeing these days.
Yeah, a little bit smaller than we're seeing today, yeah.
So a little bit about you. Let's just take you how you got to LendingTree.
Sure.
So Wall Street, straight out of school.
Yep.
So we'll get a Bucknell plug in here
Yeah.
for the crowd. So chance to work with Doug, sick of Wall Street, attracted to being on the deal side of growing a company.
Yep. There are a lot of people sick of Wall Street, and I was one of them. I had been doing the same thing for quite a while in this group. My first job was in trading. I then went to business school. I came back in 2001, was in that equity capital markets role. And the great thing about that job is that you work with an incredible diversity of companies and management teams, advising them on what investors will like, what they won't like. Sometimes they listen, sometimes they don't. But a couple times a year you got one where literally you're part of something where most companies only go public once. And it's a genuinely emotional experience for them. And I used to say twice a year you'd get a CEO who would literally have tears in his eyes and hug you.
Sure.
And that was like a very cool thing. I considered myself fortunate to be in a job in finance that had that aspect. The issue is you get bored like anything else. And I also am a big believer that you have to think about incremental skill development, trying new things, et cetera. So the fun part for me, and I got the opportunity to work with LendingTree in 2015, we did what was called, it's a hackneyed term in my old job, it's called the re-IPO. And you take an existing public company that nobody appreciates, and you remarket it, and try to get investors to care. And so we did that with LendingTree in November of 2015 at around $1 billion market cap, and it's been one of those very successful ones. But the opportunity for me was, obviously working with Doug, somebody I've known for a long time, that was important just because of the trust that was there. It's also an opportunity to stop advising and start doing, and learning new things.
So let's get to the topic, M&A in the South.
Sure.
So Charlotte-based company, right in the heart of what we're calling the Southern tech ecosystem. Mm-hmm. And you've done deals in New York in your previous life, in the Valley, I'm assuming. You've seen the major tech hubs.
Yep.
Just at opening level, what's your view of tech in the Southeast?
Sure. So, and we've got our corporate development team is here today. We our goal is not necessarily that an acquisition has to be in the Southeast, but we've acquired 9 companies since 2016. Most of them are $50 million and smaller, right? In terms of acquisition size, to give you some sense for scale. Most of the companies that we've acquired have done one thing incredibly well and focused on that one thing and probably not developed other aspects of their business. And there's one general common ground. We're only going to acquire things that we can make grow faster. Being part of the platform has to be an advantage. It has to give them a competitive advantage in their marketplace. So we have to think a lot about the people. Now, we've done deals where we knew that it wasn't an alignment in terms of the principles.
Yep.
We've done deals where the principles are critically important. Identifying that early is a big deal. I also think people greatly underestimate how much analysis we put into the people and whether they are inclined to stay. And we try to have a really open dialogue on that up front. So as it relates to the South, well, we would always look at, okay, what's the motivator for this person who started this business? How long had they been at it? Does it feel like they want to move on? Or does it feel like they actually want to move on? They want to keep moving forward with the business, but with a partner. So we think a lot about that. We just acquired a company in Seattle in October, and we went line by line with the CEO. We have a 3-year earn-out in this deal. We went line by line with the CEO as to every employee's compensation as part of QuoteWizard and prospectively as part of LendingTree. And it was incredibly gratifying and reassuring to see that he wanted to do that he cared that much about his employees. In that transaction, employee retention was critical. So as we think about the South, we look at it and say, geez, if we were a company here in Charleston, great place to live, obviously, we're kind of working on the assumption that if you can be a good growth employer in Charleston, for instance, that you can retain people, right? So one of our acquisitions that we're really proud of is SnapCap, here, and which we made in September of 2017. And we're thrilled that we're expanding that office, right? And we look forward to the day when somebody who's been working at LendingTree in Charlotte says, I'd like to go work in Charleston. And it doesn't have to be for SnapCap. That we have the opportunity for somebody to move to Charleston is a great thing.
So reflecting both at Merrill and LendingTree, from your side of the table, when you're assessing deals, we often hear a couple big pillars of deals: team,
right,
market size and market they're going into, and fundamentals, business fundamentals, financials. So how do you rack those? How do you go into a deal on your side of the table, assessing those, and overlay stage of the deal, size of the company, and how do those priorities stack up based on different sizes of deals?
Yeah, I think a lot of what we think about is, what are we acquiring? Are we acquiring a capability? Or what is that capability? Is it product? Is it marketing? Most of our deals have been about diversification. So for us, LendingTree started as being all about lead generation for mortgage. As recently as 5 years ago, it was 80% mortgage. Today, we are 20% and going lower because we've diversified. We've gotten into credit card. So for us, it's really been about, what does that business mean for us? Go forward, I think that changes.
Yep.
We've now gotten to the point where our diversification is such that that's no longer really the goal. In certain scenarios, it might be, but we have to think about, are we acquiring a great technology product or people, or are we acquiring a capability? I think the other piece of it is, we do spend a ton of time saying, how critical is the team? The other thing we look at is, and Doug pushes us on this all the time, towards the very end of the transaction, it's always hysterical, because he'll say, well, could we build this? If we could build it quickly, we wouldn't have spent 6 months looking at the acquisition, right? So but that's always a question, and it's just a speed question. So it's hard to say. Every deal is totally different in terms of what our goal is.
Yep. How important is the management team when you're sitting across from the table?
So I think it's important to understand how they got there. We made an acquisition last year where in a company called Student Loan Hero. That management team had done a good job getting it to that point, but it was very evident that they looked at their opportunity differently than we did. They were 60 employees and had every intention of growing it to 100. And we looked at it and said, geez, we can do this with 25. And not that we wanted to lay people off, that wasn't the point. It was just a philosophical difference.
Right.
So far better to have an open conversation about that before the acquisition and understand what their goals were. So we were very open with them, right, and we effected a transaction that got them to their goals, and it's worked for us and it's worked for them. But we were not going to have alignment operationally, so why set up that failure, right? So we think about that. It kind of depends, Marc, because in the case of insurance, which we just got into, we had a couple people internally spending time on insurance. We didn't have any capability there. So we acquired a team that is now our insurance team. So their management is incredibly critical. If we had turnover there, that'd be a real problem. But we've certainly had acquisitions where we have turnover and we can live with it. It really depends on what capability we have in-house.
So how have you set the strategy since you got there? Is the strategy to get into adjacent markets, to go deeper in your current market, get into new fintech? What's the strategy, and how do you think about setting that both near term and long term?
Sure, I'd say it's evolved. So not all of our diversification is through acquisitions. One of our better businesses at LendingTree is the personal loan business. That's entirely organic. But for the last 2 years, it has certainly been diversify. That's how you get through a year like 2018 when interest rates go up and our mortgage business shrinks. If everything else is growing, you can get through a year like that just fine. Go forward, that strategy will change. We appreciate diversification. We just don't need it as critically as we did 2 years ago. I think as we move forward, it becomes about, it's actually, I think our strategy is evolving to be more about what we can do for the consumer or borrower. And so we have a platform called LendingTree. LendingTree has 10 or 11 million members, okay? And actually, I think as of yesterday, it was 11.4 million LendingTree members. Well, that platform is really the hub for how we want people to interact with LendingTree. Go back to the core of the business. One of the fundamental problems with it when it got started was that it was all around mortgage. Well, how often does the average person engage around mortgage? We now want repeat engagement. So our acquisitions will start to reflect that. We're going to try to maximize our marketing spend by more points of monetization along the way. Effectively, our diversification should become a massive competitive advantage and operational advantage, because for every dollar we spend in marketing, we have a much greater chance of monetizing that. Now, the challenge is making sure that that diversification doesn't become dilution. So we spend a lot of time looking at how many employees do we have dedicated to certain businesses, and is that the appropriate scale relative to our competition? Because we have certain businesses we know we're probably just under-indexing in terms of our contribution. So we have to think about acquisitions relative to that as well.
Get into that just a little more, because I think that's an interesting point. So how do you think about the dilution?
Sure.
Because I think that's a topic people probably don't get your kind of view on.
Yeah, so we talk an awful lot about flywheel businesses, right? And that's something that certainly you go back to the internet businesses that had that model as well, whether it's an open table or otherwise, right? That the scale is the advantage. Well, for us, points of monetization are the advantage. For every deal we spend every dollar we spend in marketing, if we are in multiple products, we should win that game. We should be able to spend more in marketing because of our monetization. So that is core to our business. We think about in terms of dilution is, okay, credit card, personal loan. How many people do we have dedicated to those businesses when we're competing with people who that's all they do? All they do every day is think about that. We have to make sure that we are on the front burner in terms of how the issuers in card, for instance, are changing their thought process around how they interact with us, how they think about data, what they want from us. We don't want our product to become a second-rate product because we haven't invested enough in that sliver of our business. Right. We have the good fortune of 4 big businesses being roughly 20% of our business in any given quarter. So mortgage, insurance, personal loan, credit card. That's wonderful. It's a much better model for a public company, by the way, but it presents its own management challenges.
Right. So the downside of being big is you have people nipping at the fringes of your business, sometimes startups. So as you look at your M&A strategy, is that part of it to look at younger startups that are eating away margins or on the fringes of your business and seeing them as targets or planned targets?
Yeah, we have not yet gotten to the point, yes, it is, absolutely, but we haven't gotten to the point where we're analyzing, do we buy those guys to make them go away? Because generally speaking, there's going to be another one right around the corner. And so that's not really what we want the M&A strategy to be. Now, I can understand in certain businesses why that's a rational strategy. I am happy we're not there. But we do look at people who are just doing something better than we are. And we look at, one of the things we push ourselves to do is don't assume that we know better. We actually try to say, like, when we look at the people in a company that we're acquiring, we try to look at it and say, like, there's a reason why they're successful. There's a reason why we're acquiring them. They might have a better solution here. So, SnapCap's a very good example. We were in small business lending, but the traditional LendingTree, what we call the exchange, a very automated kind of a process, wasn't actually that effective for many of the lenders that SnapCap was succeeding with. Their process is much more concierge. What we did there was basically say, okay, what the key was making sure that when a borrower comes in, what's the right journey for them? Is it the traditional SnapCap experience or is it the traditional LendingTree experience? And it took us some time to integrate that, but it's actually showing real signs of benefit now. But that's something that we accepted that they were doing better. And so there is no, I get asked this question all the time, it's like, what's the playbook? Is there a LendingTree playbook to how you integrate these things? And the answer is, there's a playbook as to like the internal process and how we need to make sure that we integrate the data and things like that, but not around people. Like, we have to look at what they do well and actually look at every deal differently.
Right. So kind of staring back to the South for a minute, if we say your criteria is team, tech, and the talent behind it, the tech and the market size, how are we doing in the South?
It is Charlotte is getting, well, so I'll talk about it from a Charlotte perspective, but I think it holds across many areas of the South because just the demographic trends are so great. Marc and I were talking about this earlier. People who come down to Charleston on a vacation and then suddenly want to move here, it's a pretty good dynamic if you're an employer. We get that in Charlotte as well. Maybe not quite as much in terms of the nice history here in Charleston. The demographics are definitely in your favor. We're finding it easier to hire in certain roles, marketing, product, et cetera. People with families moving to Charlotte from the Northeast is a no-brainer. We're recruiting successfully with people who start their process thinking they're going to be remote, and then, through the recruiting process, they come down to visit, and then we get this kind of sheepish phone call that says, I might be interested in relocating. So it's working well for that type of employee. Now, in tech, for senior engineers, it's still a bit of a challenge. And we're not in uptown Charlotte. We are, I was joking with Marc earlier, Charlotte is definitely a real estate town. So every time there's speculation as to where we're going to move, there's a news story about it. But we are going to end up moving our headquarters. And one of our key factors is where we'll be able to recruit from. Can we leverage the university footprint there, right? And here, obviously, whether it's Clemson or South Carolina or College of Charleston, that's critically important for any startup around here is tying into that network. We're only recently really investing in that and recruiting at colleges, and our best way of doing it is that the answer on interns is pretty much always yes.
Yep.
Right? Because it's a very cheap way for us to get a look at somebody and win them over as a good employer in a region they want to live in, right? And so that's why I get excited when we talk about Charleston growing as a presence for us. We now have offices. When I first got to LendingTree, we had Charlotte headquarters and Burlingame headquarters, Burlingame, California, and we now have offices in New York. I'll always leave somebody off on this, which is never a good thing. We have offices in New York, in Charleston, in Jacksonville, Florida, in Chicago, obviously Burlingame, obviously Seattle. We have an office in Denver and Sacramento. It's not exactly the real estate strategy that one would put together at the outset, but we actually want it to become, I think I neglected to mention Chicago, we want it to become an advantage for us. So I think we're doing what you're doing, which is we're tying into the universities on one end for young people, and then we're trying to sell the advantages of the Southeast relative to the Northeast or the Bay Area in terms of cost of living and quality of life. And that's working for the people who are more developed in their careers and where family is critical.
So when you're assessing a company, for those of us who've been on one side of the table, trying to sell a company, talent always comes up. Can you scale a company in Charleston, South Carolina? I got it. Do you worry about that, or do you get them under the LendingTree tent and say, we'll figure out the scaling issue once they're inside our organization?
Well, yeah, we have not, the companies that we've acquired, we've integrated parts of them, but we've left them relatively independent. And usually they're at a stage where finding talent for them isn't really the struggle. It's more, our biggest hiring challenge is two areas. In the Bay Area, it's incredibly not only expensive, but it's just to retain people is very hard. And then senior engineering talent in Charlotte remains a challenge. Those two areas are really it. Beyond that, we think a big part of it is giving the acquired company the resources to draw talent. So we acquired a company called Compare Cards in November of 16.
Charleston,
Chris Metler's here in Charleston. And well known, and has been great. It's been a great partnership for us. But a lot of that team is in Chicago, and they were in Northbrook, Illinois, where their office is outside the city. So we recently, and we're going to be moving shortly, that office into the Loop in Chicago for talent purposes, to give them the ability to scale that business. That's our card team. That's an important business. That's a big wallet. That's a big opportunity for us. We need to be able to attract
people
talent.
Want to be downtown.
People want to be downtown. We should be able to hire people from Groupon and from Grubhub, right, that are right around the corner. We're going to draw those people if we have the resources, if we have the office space, et cetera. So we need to, that's something that on their own, Compare Cards may not have invested in, but we as LendingTree should absolutely invest in.
Right. So a little bit of a tougher question. So people say you can grow a great company anywhere. How do you view the statement?
I'm not sure I buy into that. And I say that from the standpoint of, it's all about people, right? And so the anywhere comment, I always look at it and say, who are you attracting? And by the way, that cuts both ways. We, in our process of evaluating our move, we've come to realize that we have a lot of employees who really value being in the Ballantyne area of Charlotte, which is suburban. And what I struggle with is, okay, that we have clear selection bias in terms of who came to work at LendingTree because of where our offices have always been located in the suburbs, and people like being able to, drive 5 minutes to the office if they so choose. The push-pull on that is we want to be near the university footprint, we want to be near the light rail, we want to get the biggest pool of talent. But do we have better loyalty from the people that we have today? And we have to look at that. So I'm not sure, let me get back to your initial question, which is can you do it anywhere? It depends. How people intensive is the business? Right? If you're going to grow a business like Compare Cards that was doing it with fewer than 15 people, sure, you can do that anywhere. If you have a people-intensive model, I don't agree with that.
So shifting gears a little bit, I'd love you to just give some advice to young entrepreneurs in the audience. So if they have M&A in their future, then everyone should plan for some level of that if you're starting a company, I believe. What do you see on your side of the table? Like good business practices, risky areas that people get into, weak business fundamentals. Where do you focus your time? The early entrepreneur, so if that's out in the distance, you're ready for it.
So the mistakes that people make in this context are actually the same mistakes that management teams make when they're thinking about going public, which is they think that the IPO itself is the end zone, it is the finish line, and it's not, it's actually just the beginning. Similarly, when we talk to a company that we're going to acquire, it's very evident to us whether they're just heading for the exits. Did they set up this business to be sold? If they did, we have to question how enduring it is. By the way, it still may work for us, that's fine. But sometimes it's really obvious what their goal was. Doesn't make them bad people, by the way. But did they build something that's kind of built to last? Probably not. And so we have to then scrutinize it that much further. So there are certain things that they do in the lead up to being sold that are obvious, right? They cut back on certain staffing. They cut back on their office space. There are all these little signs that they were gearing up to goose their financial profile to be sold, which is fine, I get it. But don't think we don't see through that.
It all comes out in due diligence.
Yeah. So it's but it's the same mistake, right? When you're acquiring a company and the principal or the founder is passionate about it, and when you're buying a company that is a trade, and so don't think you're going to fool. My advice would be don't think you're going to fool people on that. The reality is, it's pretty obvious.
Yep. So there's so much capital out there right now, right? Yeah. And for good companies that have really any level of growth, there's access to capital. And I think a lot of young companies are very attracted to that. I think unfortunately people see that as a goal, not just a financing event. So when they finally get to the deal table, how do you view taking on too much money? And what's your advice on being pragmatic about that? Because you have to think about how it's viewed downstream.
Yeah, it's interesting. There's so much context there. One, the market has shifted so much. I was joking with Doug, our founder, about when he took the company public in 2000, and it was such a different IPO environment. I want to say the total proceeds were $39 million. And that was common at that time. And he will tell you time and again in that scenario, he did not raise enough money. And he had the conversation about should he raise more. If you remember, for those who were around at that point, if you remember in 2000, a lot of the companies that went public in that window actually were setting themselves up to raise more money in 6 months. It's really dangerous. But nobody goes public that way anymore. The only sector where that happens is healthcare and biotech, because they don't want that risk of being a public company who can't raise money and then having to look at your stock price every day. So generally speaking, I would always tell people to overcapitalize somewhat. They tend
for growth. Focused on growth.
To focus on growth, and also to make sure that your fundraising does not become your principal activity, right? Like at the end of the day, there are a number of startups where the CEO or the founders spend an inordinate amount of their time just raising money. And that becomes the goal, and I would argue it becomes the distraction. So I would generally say for many, depending on their model, it kind of depends. I think you have to look at how competitive and crowded your space is. And if it is crowded, take more money. Because don't assume that it's going to be easy to raise money the next time around.
Right.
If you're a unique company, you can get away with things, and you can skinny it down and keep as much equity as possible and bootstrap things. If you're truly unique, that money will be available for you. But there are definitely companies that we look at today. We had recently some companies come in to visit, and it was like they're in a segment that I won't comment on the segment, but they're in a part of our ecosystem where there are so many companies out there that it felt like Shark Tank. And that's not a good dynamic. But by the way, 2 years ago, they probably had money being thrown at them.
Yep.
And today they're running out of options. So I think you have to think about how crowded your space is, and then that should dictate whether you take more money or less. And then I think the other piece of advice I'd say is don't become obsessed with the Marc progress. There are so many people that I think find the mark on their fundraising as being the goal, and that they can tell everybody that they just got valued at X. And I would say most of the time that's not really the right value.
Right. I'm going to leave about 5 minutes for questions because I think it's great to have JD here. I want to take advantage of that for the audience. But let me run through some IPOs.
Sure. Yeah.
And this was off script. I'm sorry. Some IPOs and just get your reaction to it. So I'm going to pick on one that I like to pick on, Snap.
Reaction? Yeah, it's all the mistakes that everybody else made. Can I give a one word?
Yeah.
Arrogance. Go. There's no other way to describe it. It was unbelievably arrogant, and they're paying the price.
But in your former life, you were on those roads, you were the other side of
the hardest part of the job was having to chase things like that.
And clearly, banks like Merrill and others bought into it.
Yeah.
So, what's going on in the environment right now that those things are happening? Because you can continue to see it a little bit.
Sure. So the difficult part at banks is unfortunately what I call management by Wall Street Journal. So a company like Snap, prior to their IPO, they do what they probably should be doing, which is the fervor over the excitement, the fervor and excitement over that business is such that they can get banks to line up to lend them money even though it's uneconomic. The great unfunded revolver that all the banks will commit to for Snap, for WeWork, for Airbnb, for all. It's a money-losing proposition. The banks only do it because they're going to, at some point, get the IPO business.
Sure.
Snap, in particular, had a financial profile where they were burning money, and it was extraordinarily difficult to lend money to them. And I remember many conversations where rational people sat at a table and said, we're not going to lend the money. And then, of course, the headline goes across Bloomberg as to who the underwriters for Snap will be. And the phone call comes from on high. Why aren't we in that deal? That's what goes on at all the banks. And if it's any of the unicorns, WeWork, Snap, otherwise, that's what you spend your time doing. It's a quick way to take people and run them out of the business because it's not a lot of fun chasing companies like that. Yep. So a company like Snap literally was telling you to commit to lending them money and sharing next to no information as to their financial profile. A company like WeWork raised a ton of debt on financials that they financial commitments that they continued to ignore. So I don't miss that part of the business at all. And so you have to unfortunately, because of the profile of those deals, you have to engage and spend time on that. It's just not the fun part of the job.
So Uber or Lyft?
Yeah. Oh, geez. Uber. Uber, just largely because he's done it before. The answer would be different if we had the old management team.
Airbnb next year, out in the future?
Yeah, next year, and that's one of the businesses that I would bet on. So I like Airbnb, and I think they'll figure it out, and it's the opposite of Snap.
Okay. So outside of Doug, CEOs to watch. Who's doing a great job?
It's so funny. People ask me whether I still follow the IPO market, and the answer is no, which tells me that I made the right move getting out of it. CEOs to watch. I don't know that I have a current answer. I've been pretty busy with my head down at LendingTree.
So we'll stick with Doug.
Yeah.
You okay with a couple questions?
Absolutely.
All right.
Just 1 second.
Hey, thank you. What are your thoughts on the dual-class voting structures at all these companies these days? It seems so popular.
Sure. So the first IPO that I worked on, start to finish, in 2002 was a company called Dick's Sporting Goods, and about a $400 million market cap at the time, and it was a founder-led company, family business, and I remember it was controversial because it was dual class, and it also went public in October of 2002. It's an extraordinarily difficult market environment. The reason he got away with it It's because he was the founder. I used to say, like, when somebody's selling stock at the IPO, you always look and say, well, do they still have skin in the game after they sell? Like, do they still care? In his case, he really cared. So dual class share makes sense in scenarios like that where you have founder commitment. Now, people would argue with me and say that that can go too far, and that Lyft is a good example where their economic ownership is not commensurate, even close to their control. The market continues to allow it. In the case of Dick's Sporting Goods, I remember people asking me, like, why'd the market let him get away with this in a bad IPO market? The reality is, like, I've seldom seen a scenario where that is the deal breaker. There's probably a discount associated with it. I'm sure Snap probably has something there, and it probably factors into their valuation today. But it's going to continue to happen just because if the business is unique enough and the growth is there, the investors don't have a mechanism with which to shoot it down.
Hey there, Cassandra Worthy. I love hearing that people are at the forefront of all of your deals, and of course the umbrella to people is culture. Mm-hmm. And then I also hear that you allow your acquisitions to operate more autonomously and don't integrate a significant portion of the business. So I'm wondering, what is your intentionality behind culture and instilling the right culture? Is it more before the close and just making sure their culture aligns with what your target is? Or is there intentionality post-close to continue nurturing the desired culture?
Yeah, I think it's intentionality post-close to, well, this answer presumes that the culture are good cultural habits, okay? So there is intentionality afterwards to be respectful of what the founder and the team that you just acquired cares about, right? That culture, that you respect that culture. I think you have to be intentionally respectful of that. Now, obviously, it's a totally different answer if you're seeing a terrible workplace, but you should have found that in diligence, right? I think a mistake is trying to force your culture onto an acquired company prior to the deal or even after. You want them to be part of the overall, but in their unique way. Our team in Seattle, the Quote Wizard team, is a perfect example of that. There are definitely some things. We come back from meetings out there and you hear people sharing comments about their culture. Like, we observe really good things in their culture. And that's been really gratifying, right? When you spend the summer working on a deal and you close it in October, and then you go out and you're doing integration meetings and you realize that there are certain cultural things we can learn from. That's great. That's your goal, right? So I just think you have to be. It's about being respectful of what matters to them, and that's how you'll keep people too.
I think it was a great question because if you picked up almost every answer JD had today, threaded back to people. And I think for founders in the audience or startups, it's a great takeaway. Yeah. I mean, it's not obvious, I don't think, to everyone that the people part of this business hits on everything.
Listen, having come from a bank, I remember one of the things when I was interviewing with the team at LendingTree, somebody said, well, why do you want to come here? I said, well, in my old job, I could get a deal that might get some attention, and that's great. It wasn't, I never saw the impact of my work in our financials. At LendingTree, even despite our size, I can still see the impact of that, right, in our performance. That's more true the smaller you go towards the companies we're acquiring, right? And so one of the gratifying things about working at small growth companies is that impact that you can have. And shame on us if we lose track of that.
I'd like you to put your investment banking hat on.
Again?
Again. Sorry to make you do that. Company, 6 years old, gross revenue north of 30 million, EBIT is a little light, 5%, but that's due to the growth. A lot goes back into R&D. The way it's pitched is, hey, we've de-risked the business, and now we want to launch. What advice would you give to an owner in that situation?
Now you want to take off from there. So have a really crisp answer.
Got to raise money now. Got to raise money.
Yep. You need an incredibly crisp answer on the unit economics in your business, and ultimately that will lead to what the natural margin is in your business, right? And then what's your competitive set and where are their margins? Because the upside for any investor is one of two things. Either 30 million of revenue is becoming 60, or 5% margins are becoming 15. You need to give them a de-risked path to that margin expansion, which presumably the investor wants both, the revenue growth and the margin expansion. It depends on what your growth rate has been. How long did it took you 6 years to get to that scale? So the question becomes, I would then look under the hood at your revenue. You'd look at how many customers, what's the dynamic there, what's the retention of those customers. You'd look at a cohort analysis to see how those customers are growing with you, right? Are they adding? Is there a same-store sales dynamic that I can get behind, right? But mainly, if you're telling me that there's an immature margin profile, then you've got to decompose that and have a really crisp, like very crisp elevator pitch on why the margins expand from here.